Good afternoon and good morning to our West Coast participants. Thank you for joining today's ICD webinar, Executive Pay of Private Enterprises. My name is Scott Munn and I'm a partner with Hugessen Consulting. I'll be moderating today's session along with George Soiree. The webinar will run for 1 hour, including a 10 to 15 minute Q&A segment at the end. The session is intended to be interactive, so you're encouraged to type questions and comments throughout the presentation using the question function on the panel at the bottom of your webinar screen. We will endeavor to answer all of your questions either during the Q&A segment or through a direct reply. At this time, all the participants are in listen-only mode. This event will be recorded and made available for replay at www.icd.ca/webinars. The presentation slides will advance automatically. If you need technical assistance, please call Kim Carthy. She can be reached at 416-593-7741. Extension 289. The presentation slides are available for download now and will continue to be available after today's session. The full recording of today's webinar will be uploaded to the ICD website later today. Let's begin. Governance and compensation principles transcend all types of organizations, including publicly traded companies, private companies, commercial crowns, and not-for-profit organizations. However, there's important nuances and considerations that directors need to keep in mind for each of these types of organizations. This session will explore the range of practices in the oversight of executive pay and private and commercial crowns, and over the next hour we'll explore the governance framework, pay philosophy and principles, incentive designs, and other executive pay governance-related items at private corporations and commercial crowns. This will not focus, the focus of this presentation is not on not-for-profits. You'll find that some of the material today will be helpful for those of you that are listening in and that are on not-for-profit boards. Let me take a moment to introduce our panel. Monty Baker is currently the chair of the HRC committee at OMERS Administrative Corporation, and he's a trustee of the Slate Office REIT. He was previously a partner of the nationally recognized accounting firm and was heavily involved in establishing that firm's compensation program. Carmen Loberg is a corporate director. He sits on a number of boards in the public sector, private sector, and crown corporations. He's chair of the HR committee or governance committee or combined committee at the Port of Vancouver, McCoy Global, or Stuart Olson. He also has significant board experience with private companies and not-for-profits. George Soiree is my colleague in Toronto, and he's one of our founding partners. George and I are partners at Hugessen. We advise boards on executive pay, corporate performance assessment, and related governance. We work with over 150 clients a year. We are also very active with the ICD and support them in delivering the Director Education Program. As a side comment, roughly half of our business actually tends to be in these types of companies, which is part of the initiative for doing this webinar today. In addition to the four of us, Laurie Brotherton is present on behalf of the ICD. George, I'll pass it over to you to begin a discussion around the governance spectrum.
Thank you, Scott. So a proper governance framework is integral to the proper operation of all kinds of enterprises, and strong governance is the cornerstone also of an effective compensation system for any organization, whether it's in a publicly traded environment or in a private setting. The advantage of publicly traded companies and governance frameworks is that under securities rules, there are a lot of prescribed behaviors and protocols that have to be followed. As well, the shareholder community, whether the shareholders themselves or their representatives, including ISS, Glass Lewis, CCGG, often stipulate how they would like to see governance developed in a publicly traded company. But such rules really are not in place for private companies or crown corps. And so, no surprise, we get to see a very wide range of practices. And there can be significant consequences when the governance structure is not sufficiently robust, including inappropriate compensation philosophies, the encouragement of excessive risk-taking unintentionally. So, and ultimately, and in the worst case scenario, you see outsized pay relative to performance that's being delivered. So I'd first turn over to Carmen. If you could share with us your perspectives, Carmen, on governance models in setting.
Thanks, George. It's really important to bear in mind as we go through this material today that that spectrum you describe is really very diverse, and that we end up having different elements influence the nature of where any particular organization would sit on that spectrum. And that exists regardless of whether you're a private organization or whether you're a commercial crown or a pure crown. I think that I could probably be most helpful if I add a couple of comments about what I see by recognizing the purpose or the nature of an organization. It's extremely important that a board, and by extension, HR committee, understand how the purpose and nature of your organization is going to affect your governance framework and your governance processes. And if I could use a quick example from the port, when we were working on a review of our whole compensation program at the port, one of the things that we struggled with was a broad range of different perspectives about what the nature of the port was. In many people's view, it's simply an administrative organization. It collects rent, it issues permits, it's a landlord kind of an organization. The other end of that continuum that we work towards clarifying is that it would be a much more vibrant commercial organization that worked very deliberately at generating economic activity for Canada as a country. So before we could really wrestle with how our compensation governance processes would work, we had to understand where we fit on that commercial spectrum, to use that lens on it. So that was really important work, and frankly it was not nearly as easy as one might think it would be. And it got us in a much better place to work on the things that we needed to work on. Now, it's all well and good for the board and the HR committee to think that we've got that figured out. The complication comes on the matter of alignment with the owner of the organization, whether it's a private company, entrepreneur-owned, family-owned, or a crown. And until you get clarity about what the nature of your organization is and alignment with the owner, you've got the potential for disconnect and a certain amount of grief.
Right, if you don't get this governance framework done right at the beginning, it can cause all kinds of issues. So why don't we, it'd be interesting to get a sense of who's on the line in terms of cross-section of organizations. So we've come to our first polling question, and we'd ask participants to vote, and to do so you just click on the voting button at the top of your screen, and we'll revisit this polling question with your answers shortly, and this will get a sense of the background of the audience. So we're simply asking in terms of which organization best describes your company or enterprise. Is it a small private? Is it a mid to large private enterprise? Is it a crown? Is it a not-for-profit? Or is it publicly traded? So let's get back on discussion with the governance principles. So other than the smallest and simplest of businesses, you know, the typical practice would include at least the presence of a qualified and engaged board. And with that, you're talking about people who have the experience and the skill set and the time to carry out, you know, the board and committee duties. So even on the smallest of private companies, owners look for outside people with that kind of experience. And then what we also encourage is for these enterprises to have specific mandates written down in terms of what are the board's responsibilities, what are each committee's responsibilities, including that of the Compensation and Human Resources Committee. And that once you write down these you know, obligations, that you actually carry them out. And it's important to have those checkbacks through the year. Then, importantly, there should be a very strong agreement on how information is going to be prepared and presented by management to the board for effective decision making, including basic protocols around, for example, how big decisions are to be made, the use of in-camera sessions, effective communication between the board and the CEO, and especially around sensitive matters such as pay and performance. So Carmen, maybe you could share with us some of the best practices you've seen in play in a private setting.
George, I couldn't agree more enthusiastically with your point on the mandate and clarity on mandate or clarity on authority. that'll show up off and on through the webinar today, I think, but to speak about it in a slightly different manner, it is more often than not that small organizations tend not to go to the formal process of actually identifying, for example, board composition, what they need on their board, and the formal processes that you've alluded to in the good practices section of your comments. It's also a process that's complicated by the nature of how a board in your particular organization gets structured. If it is a political organization and it has a high-profile political nature in the environment it lives in, you're going to find that board composition may have a very direct political component as to how your board members get assembled. I think it's important that boards realize that they do have both the opportunity and, I would suggest, an obligation to actually work hard to articulate what it is that will make a good board for them, the nature of the candidates they want on the board, the skill sets that they need, and then to be prepared to advocate to whoever or whatever process you get appointed, your board members, however that process works, to be prepared to seek input on that. And that's often something in small private companies and various corporate entities of a crown nature, where you really don't seem to see organizations being active in that area. They tend to be passive and allow organizations who are appointing their board members to simply make those appointments. I know at the port in Vancouver, we as an organization have worked hard. There's a nominating committee process that puts forward good candidates for the government to make their appointments. There are a number of different appointing entities that have rights to put people on that board. But all that starts with the organization being able to be very clear about what it is that will create a good board. And once you get that in place, you have at least a fighting chance of being able to build a good governance process all around those things. As you mentioned earlier, George, certainly publicly traded companies have a different environment they work in. There's a great deal of clarity around the authority of the board, the authority of shareholders, how processes work. Unfortunately, private ones tend to be more complicated and often exist in an area where there's less clarity, and then that shows up as a problem when you get into difficult circumstances or your conditions deteriorate on the relationship with the owner. So clearly, I'm a strong advocate, George, for having clear mandates, reviewing them on an annual or regular basis. Environments in which organizations exist change. They shift over time. And the last thing you want to have is all that good work you did at one point creating these good principles and the related articulation of them sit and gather dust when the organizations change. So it's easy to let that happen, but given that organizations and environments change, a well set up organization should have a consistent process of reviewing and updating those kinds of things.
Got it. So interestingly, we've got a very good and captive audience here. The polling results, by the way, are that 60% of the entire audience is with some kind of private enterprise, split almost evenly, small and or middle large. There's another just over 10% of folks that are with Crown Corps, 15% not-for-profits, and 12 for publicly traded. So all this material we're covering today, I think, is hopefully going to resonate with the audience. So I'm going to turn it over to Monty. Monty, you've gone through a very interesting evolution at OMERS in terms of governance, so maybe you could share with the audience.
Thanks, George. Before I talk about the evolution that we made, for those that are not familiar with OMERS, OMERS is a defined benefit pension plan in Ontario with just over 450,000 plan members, and OMERS has just over $100 billion in assets, and we have just over 2,500 employees that both invest the assets and administer the pension plan. Up until 2006, the province of Ontario appointed all of our representatives to the board. In 2006, this changed such that each of the sponsors, who are folks like the firefighters, police, municipalities, etc., appointed the directors, half of them being employee representatives and half of them being employer representatives. Initially, these sponsors predominantly appointed lay members from their own organization to go on the board. However, it was governed in a very similar way as a public company in terms of committees were formed of the board, and both the board and the committees had both mandates and work plans to ensure that they completed the mandate they were to cover. In 2012, the government completed a review of the governance structure of OMERS with two key recommendations. First being that an independent board chair be appointed, and secondly, that the sponsors should consider appointing experts versus lay members to the board. To help the sponsors in this exercise, because we have 14 different sponsors that appoint to us, the board prepared a list of expertise and skills that we thought were important to have on the board, as well inventoried what the existing board members had, and similar to what Carmen said, we let sponsors know what kind of expertise we needed to be able to fill out our roster. And from my experience, being on both types of boards, the expert board members are more able to leverage their expertise to share what other companies are doing, which is very valuable to management in them both operating and making strategic decisions. And as well, the experts are more able to go in a lot more depth around the items being discussed. So whether you're a Crown corporation or private enterprise, I believe it is important and effective to model your organization's governance framework similarly to that of a public company, with directors that have the expertise you need, clear mandates for the board and its committees, and annual work plans to ensure the board and its committees carry out their mandates. With that, I'll pass it on to Scott.
Thanks, Monty. So let's talk a bit about compensation philosophy and principles. Regardless of the ownership structure or the corporate purpose, a well laid out philosophy provides direction to the board and clarity to management and shareholders. As in other organizations, the comp philosophy defines the talent pool for executives, the target pay level and mix, and how performance will influence pay in both the short and long term. In our experience, judgment is required to determine where the organization fits within the industry and among its peers. It's also required to get an appropriate mix of pay and mix of metrics within the incentive designs, and to align pay to strategy and purpose of the organization. Carmen, I'm going to pass it back to you to talk about this a bit further.
Thanks, Scott. I go back to my point made earlier that the philosophy of an organization is going to be built on matters that relate to the nature, the purpose of the organization, and it's also going to be influenced by the view of other stakeholders. For example, the philosophy of a Crown corporation will almost inevitably be influenced by the relationship to government. In the case of private organizations, the founder of the organization or a family that owns it are going to have a point of view. If it's a large private equity, private-owned organization, it's going to be influenced by the perspective, the compensation philosophy is going to be influenced by the perspective of those external influences. Clearly, there are a number of things that need to be looked at, where the company fits in terms of the industry that it exists or the area in which it works. Significant amount of judgment ends up being required to get the right kinds of decisions made for an organization, particularly in the context of external stakeholders who have either the ability to influence the organization's actual decisions or to absolutely direct them. I think that the philosophy needs to wrestle with a number of issues around whether pay for performance is critical in how you design your philosophy. Are there fundamental strategic components that need to be built into your compensation philosophy? If you get those things right, you're off to a much better start.
Okay. So we're going on to our second polling question here, and for the audience, we would like you to best characterize your overall compensation philosophy and principles at your organization. So let us know if it's the bare minimum, if it's evolving, or if it's well advanced. And we'll come back to this question in a couple of minutes. Let's talk a bit further about some factors to consider in the pay philosophy.
And Scott, if I may, maybe a reminder to the audience that we'll be happy to take questions towards the back end of the presentation. So folks are encouraged to submit those by just typing them in, and we will gather them and do our best to address them at the end. Back to you, Scott.
Thank you. So in thinking about your pay philosophy and principles, as a director, you'll find, for example, identifying pay peers and data sources to typically be challenging. Data is often imperfect, incomplete, and often you can't find comparable organizations that are truly close, and by that I mean representative of the organization on which you serve on the board. As a result, we find that we're often triangulating data points in order to come up with an informed answer. A second issue is there's a common discussion about whether there's any discount in compensation for roles that are either in private companies or crown corporations, as these companies are not required to attract external capital. However, in our experience, managing a crown corporation whose purpose is not to maximize profit, but rather to satisfy a number of different social needs can be complicated. As well, we find many private company CEOs will point out that it can be more challenging to communicate with an informed and engaged small group of shareholders rather than a large group of public shareholders. So there's two sides of that spectrum. For crowns, one question that comes up is considering the, quote, socially responsible, close quote, level of pay. We do find there's a spectrum in those organizations between those that function as a branch of government and those that compete for business and talent with the private sector. Monty, I know you guys thought about this a certain amount at OMER, so I thought I'd pass it over to you here.
Yeah, thanks, Scott. Very much in line with this slide. The OMER's total rewards principles are to align our pay with the interest of the plan members that we serve, to align the pay with the strategy of OMER's, to pay for performance, and to be market competitive as we want to attract and retain world-class talent in a number of areas. The way in which we achieve these principles or the outcome that we want to have is a high-performance organization. To achieve the principles, all full-time employees at OMER's are subject to a balanced scorecard, which includes individual performance measures as well as overall business performance, mostly measured by the return of our fund. To drive pay performance with the individual scorecards, the process starts with the CEO who completes and reviews his scorecard with the board. 50% of the weighting is on the 3-year fund rate of return and 50% on key strategic and operational initiatives that have been agreed to with the board for that year. CEO then shares the scorecard with his direct reports for them to include the appropriate ones in their individual scorecards, and this cascades down through the organization. All scorecards are set prior to the start of the year, and this process aligns us with the strategic and operational initiatives OMER is working on in that year. At the end of the year, each individual's performance is measured against the scorecard to determine their variable pay or bonus. To ensure we provide market competitive compensation, OMER's annually participates in a number of compensation surveys to accumulate market data for each management position in each of the geographies we have employees in. We get market data from our peers, which would be large pension plans, as well from other companies where we're trying to attract people from. So in the terms of OMER's, we have a large real estate group, so we would compare pay in different real estate operating entities. We would also do it with much of the investment banking, such as BlackRock and Blackstone. And in our corporate office, it would be actuaries and finance folks, which you'd get from the different sources there. So that information is obtained, reviewed with management, and used by management to determine comp, and then is reviewed with the board each year so we understand where we are relative to market against the peers. With that, I'll turn it over to George or Scott to take up the polling question.
I think I've got this one. So thanks to everyone for submitting your answers. For the interest of you on the line, we've got a group of 13% of the folks that submitted a response say that their philosophy is closer to the bare minimum. The middle group that say their philosophies and practices are evolving would represent 53% of people that are listening in. And the remainder who have a well-advanced approach that's similar to publicly traded companies would represent 32%. Let's talk a little bit now about incentive designs and best practices. And this is both covering short and long term. Going back to the strategy and purpose of the organization, we find we need to focus on the goals that best measure the corporation's performance over time. And we find that this exercise is most comparable to that found within public companies. So for those of you on the listening in that are members of both public companies and private companies, there'll be a lot of familiarity here. We do find the board and management team want to keep things simple. However, that simplicity is sometimes at odds with coming up with a design that's well aligned to the performance and minimizing unintended consequences. Of course, there's an annual review cycle that includes goal setting, periodic reviews during the year, and year-end performance evaluation. You'll also want to think in detail about how you calibrate the threshold, target, and maximum levels of performance, including that level of performance below which there may not be an incentive payout. And you'll want to think about how unintended consequences get woven into that performance evaluation, especially if there's events that are outside of management's control. Once all of that is said and done, as with any other company, you're going to want to communicate the results to all the stakeholders, so the employees, the shareholders, and the board. Carmen, I know that you've lived this world, so I'm going to pass it over to you.
Thanks, Scott. I think it's important to make sure that you view your incentive design work and how your design is actually established, that's viewed in the context of what things are really important to the organization. The financial operating information, mandate for the stakeholders, strategic objectives, how does it link to a business plan? And before you get too deep into designing your system, you need to make sure that you've got your organization on solid ground around what is it that's going to be important in your incentive system. There are all kinds of specific issues that need to be alive in your incentive system. There needs to be clarity about how it works. There needs to be transparency if you're going to be able to hold people accountable. There needs to be a clear understanding of fairness in the organization, fairness to the organization and its owners, fairness to the executive and the participants in incentive plans. So those are things that a well-designed system will clearly take into account. Scott, you've very accurately identified that you need to have some mid-year updates after you do the original mapping out of your incentive plan for the year. Organizations seem to be changing components of their environment more often than ever in these times. So it's critical that there be some kind of a recognized mid-year update, because nothing can be more demotivating for an executive team or board than to have a dramatic, unexpected shift in the environment that doesn't get dealt with and simply scrubs or stymies a compensation program for the balance of the year. Inevitably, once you map those things out, you need to make sure that there's rigor around evaluating outcomes, and those things tend not to be as easy as you think they are. So the more clarity you have, the simpler they are, the better you're going to find your ability to get what you want out of your incentive design and the resulting program.
Why don't I talk a bit about the continuum of STIP approaches, short-term incentive approaches. On one hand, you have a formulaic scorecard. This is at the bottom of the slide. So this tends to be fairly simple. There's a mathematical formula that drives an outcome. The challenge may be that the simplicity may not actually align with a comprehensive view of performance. At the other end of the spectrum, the top of your slide, is an ad hoc or discretionary approach, which may well be a fairly comprehensive view of performance, but it may not provide the executive or management team with the clarity around exactly how the performance evaluation was done. Obviously, that's dependent upon the extent of the communication provided, and there is an opportunity to have both clarity and comprehensive view of performance at the same time. In the middle is the metrics-based approach. Here you tend to have a common set of metrics in the middle that provide some degree of clarity over performance, but it also leaves some judgment for the board to reflect new information determined during the course of the year. Carmen, I'm going to pass it back to you, as I think you wanted to make a comment in this area as well.
Scott, we probably should think in terms of the different participants we have in the webinar today. Certainly smaller organizations often have very simple, straightforward, cash-driven incentive approaches. Often it's a cash plan that either arises from the creation of a pool based on earnings or a percentage of earnings in some manner like that. So again, the nature of your organization is going to influence how that works. If you have a private company with strong historical ownership that was active in the organization, you're going to have one kind of outcome as to what the best approach to the amount of discretion versus the amount of formula that's approached in the process. As you move into more sophisticated, larger organizations, you're likely to move towards a much more formulaic approach that's driven on clear metrics that will be easily identifiable and easily agreed to in terms of the performance measurement that's being adjudicated. Certainly, scorecards tend to end up being more complicated than they should be. I've learned the hard way that the more complicated the scorecard is, especially for short-term kinds of incentives, the more difficult it's going to be to administer it, and the more opportunity there is for disagreement as to just how well it works and how fair and transparent it's seen. So certainly there are different ones. I think that a good HR committee and a good board and a wise owner will be able to figure out the most appropriate of the approaches that are listed on the slide as a continuum of approaches to the STIP design, or rather the STIP program.
Okay. I'm going to speak just briefly about the corporate scorecard that's going to be on the next slide, and it is an example of the metrics-based approach, and then Carmen, I'll pass it back to you. So what you see on this slide is a combination of financial and operating measures. Sometimes you also see categories for strategic initiatives or individual objectives. In each case, you see a threshold, a target, and a maximum, and here they've put in a sample of the actual outcome. Clearly, coming up with those ranges is quite important, and tied to that range is the level of bonus opportunity. So what level of short-term incentive would you pay at threshold versus maximum, and what's the line, if you will, in between those two data points, and most importantly, to what degree is that steep or shallow or broad or narrow. Overriding all of this is some element generally of board discretion around the overall performance and the degree to which the scorecard matches that comprehensive view. Carmen, back to you.
Just to add a couple of points, Scott, to the layout of the scorecard on the slide. It's a perfect opportunity to add other elements that you want to be reflecting as objectives for the organization and success measures. For example, it's reasonably common now in organizations to find health, safety, and environment as a metric that's in an organization scorecard. Sustainability, environmental kinds of issues are all now starting to come into play in scorecards. We had two sets of scorecards really at the Port of Vancouver. Use that as an example. The Port has a very sophisticated and very complicated corporate balance scorecard for the entire organization, and the entire organization is engaged in that, and its overall performance is being measured by that scorecard on an annual basis. We also have specific individual scorecards for the CEO and the executive leadership team. They are places where we measure, identify and measure more strategic components for the performance of that particular executive or that particular individual. Again, there's this phenomena that we tend to want to measure too many things. And I personally believe that a CEO's measure even in a reasonably complicated organization really needs to focus on sort of 3 to 5 things. And more organizations have got dozens and dozens of things that they try measure. Again, it's complicated, it's hard to adjudicate, it introduces the potential of a challenge or a disconnect around fairness. So as you lay out a scorecard, my key thoughts in my own approach to it is make sure it's simple, make sure it's clear, and make sure it's fair, and that it is based on matters that you can in fact adjudicate.
Thanks, Carmen. I think we'll now turn our attention to the LTIP that when and where they exist in private enterprises, and of course they're not as prevalent as in what you typically find in a publicly traded company. So you first have to ask yourself why would you have an LTIP? And the two key drivers that we typically see as to why an LTIP is introduced in a private setting is firstly a desire to have a stronger linkage of pay over a longer period of time, i.e. over a longer performance period. And then secondly, the pure ability to have the compensation program, at least in part, act as a retention tool. So again, as mentioned by both Carmen and Monty earlier, to have an LTIP, the organization has to have a clear sense of where it's going in the mid to longer term so that the program can support that direction. If we now go to what are the conditions under which you'd want to set up an LTIP, first and foremost, to put in an LTIP, you have to have a view on how it's going to fit in the total compensation of the employees. So if you have already existing salary, you already have annual bonus, and you have benefits, how would an LTIP fit? And does it fit? For example, in private enterprises and crowns, where potentially there's already, let's say, an existing pension plan that's quite generous, is there really room for an LTIP? And if you do introduce an LTIP, what else do you have to adjust so that the total pay program for the affected employees is still consistent with the pay philosophy? Lots of homework that has to be done on those kind of factors. Another key reason to have an LTIP in a private enterprise, it's a way to have a sharing of the value creation between management and the owners. And different LTIP instruments can help in delivering this kind of sharing. So in its simplest form, in a private enterprise where you're going to use a simple stock option plan, let's say for 5%, all that's really doing is saying, management, we're giving you, as owners, we're giving you, as management, 5% of the upside, i.e. value creation, from this point forward, and as built over a long period of time. Very simple. Now, it can be very complex, and it really is a function of your organization's appetite for complexity as to where you want to go. It does require a lot of time and energy, and you have to get all the stakeholders on the same page as to whether they want to go down that road. The board, the management team, and the owners have to all be singing from the same hymn book if they're going to be adopting a more complicated LTIP program. And you also should have the right resources around the table, whether it's tax, accounting, other advisors to help along the way. So on the next slide, let's touch a little bit on the types of LTIPs that we see. And quite frankly, we'll probably have a webinar on these next couple of slides. But in its simplest form, a deferral of an earned cash award this year, just a simple deferral of part of that can be a form of LTIP. Lots of companies do that. And one of the things that does achieve is simply a recognition that if you want to collect your full entitlement, you need to be still an employee 2 or 3 years down the road when the second part that's being deferred actually vests. So that does create some retention value. A lot of other companies decide to implement a special program over 2 or 3 years or longer, and the special program is really tied usually to an event. It can be to a special project that'll take 2 or 3 years to implement. It can be tied to the achievement of synergies in an M&A situation. But clearly, the way to do that best is if you have very clear goals and milestones that you want to achieve, and the clearer those milestones are, then the clearer you can establish a pool of money shareable by a designated group of employees if those milestones are achieved. So you can also have programs that are part and parcel every year. They're awarded every year. They cover multiple years. Each award covers multiple performance years. And in fact, Monty, we're going to get you to talk about the experience at OMERS in that regard. And none of these, the ones I have in mind here, actually are tied to equity at all. So if we then look at those that, LTIPs that use equity of some sort, either real or notional equity, things get quite a bit more complicated. And one of the reasons for which it gets complicated is that the stakeholders around the table have to have a view on how to value the business for the purpose of the comp plan, since you don't have the convenience of a publicly traded price as you would for a publicly traded company. And so there are all kinds of ways to do that, and you could either have a simple formula, for example, a fixed earnings multiple approach, or you can have a triangulation of approaches. Sometimes some companies use the use of a third-party evaluator to evaluate the equity of the private enterprise every year for the purpose of the comp plan. But again, for those who have not embarked on that kind of exercise before, obviously it requires quite a bit of heavy lifting, a lot of thinking, but many, many companies do that. In terms of the kinds of instruments that we see, there are simple stock option plans. Then there are the more complicated performance units. Again, that's more like a full equity grant that vests 3 years later, and you attach some kind of performance condition to it over that 2 or 3 year period. And you see a lot of these in the publicly traded environment, and many private companies have adopted the exact same concepts. The challenging part is not the mechanics of the incentive design. The challenging part tends to be the selection of which metric over the midterm most closely aligns with the midterm objectives that the organization is aligned to achieve. Is it going to be growth? Is it going to be profitability? Is it return on capital? Is it cash flow? Whatever those midterm metrics might be. And a lot of rigor goes into establishing those. So we're going to now get to our third polling question. For those that do have a long-term incentive program, or actually I'll also capture those who don't. We are interested to know which fraction of the audience actually have no LTIP, which ones simply use a multi-year cash award, and which ones use an equity-based cash award, so it's not real equity, and which ones use actual equity. And Monty, maybe we can turn back to you on what the experience at OMERS.
Yeah, thanks, George. In terms of OMERS, we couldn't figure out a proxy for a shared-based plan, so we have, based on that prior slide, a cash-denominated and settled LTIP program. Critically important for us to have an LTIP program to be competitive in our marketplace and to look at long-term behavior. The way in which it works at OMERS is that all employees have a base pay and short-term incentives. The more senior folks in the organization, about a quarter of them, would receive long-term incentive. The more senior you are in the organization, the higher the incentive comp. For instance, at the lower levels, when you first join OMERS, about 5% of your pay would be incentive, versus at the most senior levels, 80%. So having more at risk for our more senior employees helps drive that pay for performance, as well aligns with their responsibility within the organization. Short-term incentive is paid out at the end of the year, while long-term incentive is paid out over 3 years. The total incentive payout is determined by performance against the scorecard. So the scorecard I described previously is used both for short-term and long-term incentive. You basically have a very similar scorecard as what Carmen had: threshold, target, and maximum performance that you accumulate for each individual to determine what the actual payout is. For those that have long-term incentive, about 35% of that total incentive is paid out as a short-term incentive, while the remainder is long-term incentive, as I said, paid out over a 3-year period and goes up or down with the fund return at OMERS. The purpose of the long-term incentive is really to serve as a retention tool. So if you leave while you still are owed long-term incentive on your own, you don't receive any of it. It aligns our pay to strategy, and just as importantly, it puts an emphasis on longer-term performance, which is critical to OMERS. It's also important to note that it's not just the long-term incentive program that drives long-term behavior, it's also in the scorecard. So as I said before, total fund return it's a 3-year average. So again, not to incent an employee to take a big return in 1 year at the cost of future returns. So again, you do a mix of both short-term and long-term in the scorecard, and then you have long-term incentive for the more senior people.
It's interesting that you, along with the other major Canadian pension plans that have kind of set a standard for, in the world, have each come up with unique multi-year plans that all, as a general principle, try to align the performance over time, because trying to do it just in 1 year really is not the trick, but you found a way to do it. So we'll take up our polling question. No surprise, almost half of the audience are in organizations that actually have no LTIP, and of those that do, 21% have a multi-year cash award, therefore not tied to equity. 18% have some kind of equity-based, but still paid and linked to cash. It's not using real equity. And a small number of folks, 11%, actually have a treasury-settled program. It's not surprising, and it points to the challenge of sometimes implementing and the appropriateness, quite frankly, of having an LTIP. So I think we're going to go now, Scott, back to you.
Great. So we're on to the other executive pay governance provisions, and I'm just going to address these briefly. On the issue of employment contracts, we tend to see within private enterprises a focus on the severance provisions for the top executives rather than change of control, just because change of control is generally considered to be less likely of an outcome. On the pension plans, we see both or all types of private enterprises focusing on the competitiveness of total compensation or total remuneration. We see them focused on the affordability, and with respect to Crown corporations, as many of them had defined benefit plans in the past, they're often wondering about the transition between defined benefit and defined contribution. Regarding clawbacks, the interesting item here is that we see often a fairly aggressive position taken by private enterprise regarding clawbacks, and it's because some of the financial measures used in short-term incentives are also used in long-term incentives. And so there's a focus on the ability to claw back or somehow recoup compensation where there has been a material restatement. And that's especially true if it's been accompanied by any kind of misbehavior on the part of an executive. Carmen, back to you.
Yeah, really quickly, Scott, I know we want to get time for questions from our participants. On the employment contracts thing, it is really helpful to have your compensation advisor involved in looking at the nature of an employment agreement. It should be addressing the matters of compensation to some degree. It also needs to be flexible enough that it can be evolved over time. So don't just have your lawyer do your compensation or your employment contract. Get your compensation advisors in that process as well. Absolutely, pension plans introduce a whole lot of challenges. Defined benefit plans are expensive for sure, and they're problematic for organizations, especially when they run through the whole organization. But as an executive tool, it's not the worst tool to provide security and an attractive component of compensation. And clawbacks, it's getting to be more and more of an issue that people are going to have to deal with at the comp committee and board level.
Okay. Hey, George, why don't we pass it back to you to sort of spearhead the Q&A segment here.
You bet. And thanks to the audience, we've received many questions. Unfortunately, even if we had half an hour or more, we wouldn't get to all of them, so we'll do our best. There are a few that related to pay philosophy and pay benchmarking in a private setting. So perhaps we'll go to one of them. One of them has to do, somebody was asking, in rough percentage terms, how much of a company's pay philosophy should come from management, how much should come from the board, and perhaps, Carmen, if you have a view on that, you could share.
Well, I do have a view. I don't have a view of a percentage that would be useful. It's critical to have management involved in the development of that. You've got to understand what it is that's significant to management in your philosophy. If a board does it in isolation, the chances of it being successful are relatively slim. So it has to be interactive. I think it needs to be iterative. And ultimately, of course, the authority for final decisions rests with the board, and they live with the consequences of that. But clearly, it can't be done in isolation, and the degree to which it's done interactively, you're going to end up with a much higher level of commitment from both sides and a much more successful program.
Right. Thank you. There's another question that dealt with, we referred earlier in one of the slides to a triangulation exercise when dealing with data that's maybe hard to come by. Scott, perhaps you could share experience, and Monty, feel free to jump in if it's something that resonates.
So what we've observed in working with these types of companies is that you don't see a lot of rich data of close comparables. And so the exercise that we've gone down many times is trying to find the best data available, whatever that is, publicly disclosed if possible, or from surveys, and then considering on a number of different spectrums how that particular organization may differ from either of those samples. And then in looking at the data, drawing some judgment or using some judgment as to where that enterprise sits relative to those, and maybe even considering last year's data or any other source you can provide. At the end of the time, it ends up being a use of informed judgment that takes advantage of the information that you have. Monty, I don't know if you've got anything to add to that in the OMERS experience?
Yeah, Scott, we're fortunate in that while all of the peers are predominantly private, many publicly announce the results and almost do public reporting. So we can see, especially for the senior people, you can do a pretty good comparison against your peers and get a lot of that information. It's not always there, but you do get some pretty good information there. I think the other thing is that with that information, you also know how they performed relative to how you performed, how they got paid relative to how you get paid. And that's one really persuasive piece of information that we use. But we also, there's a number of private ones where you would not be able to get compensation numbers. And again, it's either through hiring people at a senior level where you get that information, or through other sources. So it's not easy, but it's very worthwhile. And the more robust you can get around context to be able to compare the role of your senior person with the role of the person you're looking at or the group, the better obviously you can get at doing it.
Sticking with the compensation philosophy, one question came in about how to address the board or company that is targeting the 75th percentile, in quotes, because we have high performers, and then all the issues around using a P75 type approach. I know, just sharing what we tend to see in the market is people will align their pay philosophy saying, yeah, we'll be happy to have P75 pay if the performance ends up being top quartile, but the starting point would be the award size at the beginning is geared more towards P50, let's say, of a market in general, so that you don't end up with an out-of-whack outcome a few years down the road. Monty, just turning to you in terms of philosophically how, if you've had to deal with that.
Yeah, so George, exactly. I think just what you exactly said is that we would target around the P50, but be prepared in the incentive. There's a multiplier on it, and with the multiplier on, first quartile performance, you're going to get them up into P75 and higher. But we target a P50 in terms of where you're starting from.
Thank you. There's another good question here. What long-term metrics would typically be seen in a private company's CEO scorecard? So I'll actually interpret that question a little more broadly that says, how do you figure out a long-term metric in a private company, especially where you don't have a share price to speak of, as you would in a publicly traded company. So I'll throw this open to Carmen, Monty, and Scott as to if people want to share their experience on clearly where you do have an LTIP. How did you decide what was important in the mid to long term, and how did you put it into the plan? Oh, you want a half an hour to answer that question?
Okay, so I'll go quick. I just thought I'd talk last, but I can go quickly on, basically in terms of our CO, it's very much driven off the strategic plan. So we do a 5-year strategic plan, and then once we do our 5-year strategic plan, there's quantitative and qualitative measures in that. And in the quantitative ones, we're trying to figure out year 1, year 2, year 3, year 4, year 5, what the roadmap is to get to our goal at the end of the 5-year strategy. So it's very much driven by the strategic plan, the 5-year strategic plan, which is developed by, the CEO and management along with the board, and obviously the board approves it. And then you break it out by year based on what's the roadmap to get to your strategic objectives. We also do, on a more forward-looking basis, a 10-year strategic plan to say where do we want to be in 5 years against the 10 years. So it's all based on, or predominantly based on the strategic plan, and then agreed with between the board and the CEO as to where the organization needs to get each year of that plan.
So a related question that came up was, when do you evolve, for the CEO, when do you evolve them in setting the metrics? And would they typically propose the initial draft metrics? So I can share an experience, most kind of the common experience, and either of you can weigh in, but typically we have to distinguish between which metric should be in the scorecard or in an LTIP, and separately from that, every year you have to figure out how to set the calibration, like where to set the performance bar. And we typically see this as a collaborative exercise. Management often takes the initiative. They're close to the business. They know where they want to take it. The board is approving the strategic oversight of that, and then from that flows, well, here are the key metrics that usually is proposed by management. But in most environments, there's a healthy discussion between the board and management on prioritizing those metrics. And then ultimately, once you agree them, the calibration of where to set the bar is informed by a lot of analysis. Basically, there's a budget, there's a plan, there's stress testing, and it can get complicated, but the stronger the process you have to engage with management, then the more likely that the outcomes won't surprise you. Carmen or Monty, any other gems here you can share in terms of how to interact with management in setting the goals themselves?
George,
I don't really have.
Yeah, go ahead, Carmen.
I don't really have any gems to add, George, but what you've described there is exactly what needs to happen, and it works, albeit sometimes challenging.
Good. Well, Mr. Munn, I think we've basically come to our appointed time. So I'm going to turn it back to you. Or actually, I think I'm the one who says thanks, so that's easy to do. So ladies and gents, thanks again for having participated today. We really appreciate that. Thank you, Carmen and Monty. You've been excellent guests today, having shared a lot of insights. Thank you to the team here at the ICD, and thanks to the team at Hugessen for having put the work together. We hope you've enjoyed today's session, and as mentioned, you can download the slides from today's session immediately, and the full recording will be made available on the website within 24 hours. And for those who have submitted questions and where we were unable to get to, we will endeavor to provide some answers as part of the follow-up. So once again, on behalf of the ICD, Hugessen, and our guest speakers, thank you again for joining us today. Bye-bye.